Grug hears whispers around the fire about something called the score. Elders speak of it in hushed tones. Nobody fully understands it. Some say it judges your character. Some say it's controlled by Big Chief's hidden counsel. Some say it changes randomly for no reason, punishing good cave people and rewarding bad ones. Grug's neighbor was denied a loan for a new cave last season. Reason given: your score is too low. Neighbor had no idea what this meant, what caused it, or how to fix it. Just too low. A verdict from nowhere. Grug decides to investigate this mysterious score. And Grug finds something Tribe did not expect. It's not mysterious at all. It's a formula. A specific formula with 5 known ingredients, each with a known weight. The same formula applied the same way to everyone. Today Grug breaks down exactly what's in this formula, how much each piece matters, and the specific habits that move the number. Let Grug start with what a credit score actually represents. A credit score is a number, typically between 300 and 850. That represents an estimate of how likely you are to repay borrowed teeth. It's based on your past borrowing and repayment history. That's it. It's not a measure of your wealth, income, or character. A cave person earning very little but managing small amounts of credit responsibly can have an excellent score. A cave person earning a great deal but managing credit poorly can have a poor score. The score exists because lenders need some way to estimate risk before lending teeth to a stranger. Rather than each lender doing their own investigation, this formula provides a standardized starting point. Now the 5 ingredients. Grug carves them on the cave wall, largest to smallest. Ingredient 1, payment history. Roughly 35% of the score. This is simply, have you paid what you owed on time? This is the single largest factor, and it makes intuitive sense. The most direct evidence of whether someone repays debts is whether they have repaid debts. A single payment more than 30 days late can have a significant negative impact, and the impact is larger the more recent it is. 30 days late is less damaging than 90 days late, which is less damaging than an account going to collections. Ingredient 2, amounts owed, specifically credit utilization. Roughly 30% of the score. This is the ratio between how much credit you're using and how much credit is available to you. If you have a credit line of 1,000 teeth and you're carrying a balance of 800 teeth, that's 80% utilization. This looks risky. If you have that same 1,000 tooth credit line and carry 100 teeth to 10% utilization, this looks much healthier. This is the factor most cave people misunderstand, and Grug will come back to it. Ingredient 3, length of credit history. Roughly 15% of the score. This is simply how long you've had credit accounts, both the age of your oldest account and the average age across all accounts. A longer history generally helps the score, because it provides more data, more evidence of how you've handled credit over time. This is the factor that creates one of the most counterintuitive pieces of advice Grug will give later about why closing old accounts can hurt you. Ingredient 4, credit mix. Roughly 10% of the score. This refers to having different types of credit, for example, a credit card alongside an installment loan such as a cave sled loan. This factor matters least of the 5, and Grug wants to be clear. Don't open accounts you don't need just to diversify your mix. The impact is small, and the downside of unnecessary accounts often outweighs this minor benefit. Ingredient 5, new credit. Roughly 10% of the score. This relates to recently opened accounts and recent inquiries when a lender checks your credit because you've applied for something. Opening several new accounts in a short period can signal increased risk, and each hard inquiry causes a small, temporary dip in the score. This impact is usually small and temporary, but it matters for large purchases like a new cave or cave sled. Now Grug has carved all 5 ingredients on the wall. 35, 30, 15, 10, 10. Notice something important. The first two factors, payment history and utilization, make up roughly 2/3 of the entire score. These are also the two factors most directly within your control on an ongoing monthly basis. This means the score is not random, not mysterious, and not primarily about things from your distant past or outside your control. It's overwhelmingly about two simple, ongoing habits. Now let Grug explain the single most damaging mistake, the one that quietly tanks scores for cave people who think they're doing everything right. The mistake: confusing paying in full with low utilization. Here's how this trap works. Cave person has a credit card with a 1,000 tooth limit. Cave person uses it responsibly, spends 900 teeth in a month, then pays the entire 900 teeth in full when the bill arrives. 0 interest paid. Sounds perfect. But here's what the formula sees. At the moment the balance is reported, the utilization was 90%. The formula doesn't know you paid it off in full 2 weeks later. It sees a snapshot, 900 out of 1,000 used. This cave person is being completely financially responsible and still seeing a lower score than the math suggests they deserve. Grug's fix for this: either pay down the balance before the statement closing date, not just before the due date, or simply keep utilization low throughout the month relative to the limit, regardless of payment timing. Keeping reported utilization under 30% is good, and under 10% is excellent for this specific factor. Now Grug explains the counterintuitive one, why closing old accounts can hurt you. Cave person has an old credit card, opened 10 years ago. Cave person thinks, I don't use this, it's just clutter, let me close it. Two things happen when this account closes. First, that account's age stops counting toward your average going forward. Second, that account's credit limit disappears from your total available credit. Close the old card, and now that same 1,000 teeth in balances is against a smaller limit, minus 100% utilization, instantly. Grug's guidance: for old accounts with no annual fee, simply leave them open, even if rarely used. An occasional small purchase keeps the account active without any meaningful cost or risk. Now Grug addresses the timeline question. How long do negative marks actually last, and what can you do while waiting? A late payment typically remains on a credit report for around 7 years from the date of the missed payment, though its impact on the score diminishes significantly over time, especially after the first 2 years, and especially if it's an isolated incident. Collections accounts and similar serious negative marks also generally follow roughly the 7-year timeline. The first year after a missed payment hurts the most. Each year after that, the negative marks weight decreases. This means the most powerful thing you can do after a setback is simply don't add to it. Habit 1. Every payment, on every account, every time, on time. This is 35% of the formula. Set up automatic minimum payments on everything. This ensures the on-time box is always checked, regardless of whether you remember. Habit 2. Keep utilization low, ideally under 30%. Ideally under 10% for the best results across each individual card and overall. Habit 3. Leave old accounts open and lightly active, unless there's an annual fee that doesn't justify keeping them. Habit 4. Be deliberate about timing new credit applications. If a major purchase like a cave sled is coming up, avoid opening new credit cards in the months before, since each application causes a small temporary dip. Habit 5. Check your credit report periodically to catch errors. Errors are more common than most cave people realize. A credit score is not a mysterious judgment. It's a formula with 5 known factors. Grug now knows the formula. 5 simple habits, mostly automatic, and the number takes care of itself. Next video, Grug discovers budgeting. It takes 15 minutes a month and actually works. Do not miss it.